club. Everyone, some of you, I look at Bob back here, is waiting with bated breath for everyone to be quiet so I can begin to speak. It feels so powerful. In any case, good afternoon and welcome to the first of our forums for the year, our traditional economic forum. Today starring Tom Potiowsky, who's a state economist, and Joe Cortright, who is a vice president and economist with Impresa Corporation, which is an economic consulting group. Their topic today is called Running the Numbers, the Future of Oregon's Economy. Da, 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 da. Now, if you'd be so kind as to turn off your phones so we will not be interrupted, I will tell you of quite a few announcements that we have for this first of the year, starting with our next Friday forum, the speaker will be Peter Hutchinson, and he's co-author of the book called The Price of Government, Getting the Results We Need in the Age of Permanent Fiscal Crisis. Now, wake up, because I read a few excerpts from it, and it's really much more interesting than that title would lead you to believe. He has, in fact, been consulting with Multnomah County and helping them to employ some of the principles that are embodied in his book. He'll be talking about the principles that he's been applying to the county's budgeting process, and part of this process is going to be a series entitled the Community Strategy Forums. These will be 6 public forums, and they'll be held throughout February, and each one of them will be addressing one of the 6 priority goals that's set for the community and employing the methods that are suggested by Peter Hutchinson. The forums are co-sponsored by City Club and the Multnomah County Citizen Involvement Committee, and they are free and open to the public. They'll begin in February, and you can find details about them later. City Club is also going to be co-sponsoring conversations following each of the lectures in the Illahee Lecture Series. This year's series begins January 18th with landscape historian William Cronin, and the post-lecture discussion will be held on January 20th and will be moderated by Chris Zinn, who's the executive director of the Oregon Council for the Humanities. Again, you can check the bulletin or the website for full details. And another new City Club event entitled Final Fridays will begin on January 28th. Final Fridays will just be an informal gathering to socialize with other members or to learn how to get involved if you're interested, or just to show off the club to prospective members. The get-togethers will be held right over here at City Club Commons. It's at 921 Southwest Washington. They'll start at 4:30 and last until 6-ish. And Cafe Voila, who is our food partner over there, will be open with coffee, food, and wine. No need to RSVP, just mark your calendars for the final Fridays of every month. That final I have a problem with. I'm going to call it the last Friday of every month. And look forward to seeing you there. Our Citizens Read book for this month is Bobos in Paradise, and it will be held on January 31st at the City Club Commons, and it's co-sponsored by Portland Streetcar. And we have something new to talk about about our research reports. As many of you know, City Club is well known for its in-depth and impartial and well-researched research reports. Often they take a year or up to 3 to 5 years, some have taken, to produce them. And in the past, the report has been published, and just a short time later, the club members are given approximately 15 minutes at a Friday forum to comment on the report, and then a vote is taken to ask the members to vote for or against its adoption. However, beginning with the publication of our next research report, which is the report on the Portland Development Commission, the Board of Governors and the Research Board are implementing a new policy which will give members ample time to discuss these reports before voting to approve or disapprove them. From now on, after the publication of a research report, a special evening program will be held, and it's going to be held the Thursday evening before the Friday when the report is to be debated upon. It will be open to City Club members only, and it will happen from 5 to 6:30 p.m. right over here at the City Club Commons. Then the following day, the Friday forum will be open to the public, of course, and members' comments on the report will begin at around 11:50. We're trying to set it early enough so that people will have an opportunity to talk on it, to make comments, and to listen to the comments prior to voting, but we don't want to encroach upon our speakers, our panel's time. It's a fine balance that we're trying to reach here. So any of you who are interested in debating on or hearing the report, please try to get here early, around 11:50. Come up front so that you can be heard by each other, because there will be a lot of people still coming in at the back. We're going to try this and see how it works. But in any case, please do come to the evening meeting, and then remember to come early on the Friday. Details on all of these events that I have sped through are available on our website at pdxcityclub.org. And audio CDs, videotapes of today's program are available, and you can also check the website for rebroadcast information. Now, this quarter, our sponsors whose contributions help make these broadcasts possible are Nike Incorporated, Portland General Electric, and Preston Gates and Ellis LLP. Now to our program. Today we have two very distinguished economists who put the lie to the notion that economists are stuffy. They're already betting on who gets the extra cookie based on their performance on answering the toughest question. It's hard to keep these two under control. It probably developed sense of humor as a survival strategy when trying to work both of them with this state's economic programs. Dr. Tom Potiowsky has served as Oregon's state economist since 1999, and he's currently on leave from Portland State University, where he was a professor and chair of the economics department. His office is responsible for developing and disseminating quarterly state economic and demographic forecasts and estimating the general fund revenue. Must be a lot of fun. He holds an economics degree from Ohio University and received a PhD in economics from the University of Colorado. Joe Cortright is recognized as one of Oregon's leading economic analysts, and he directs Impresa's activities advising business and government clients on responding to the challenges of economic and technological change. Prior to joining Impresa, Joe served as the Chief Economic Development Staff Person for the Oregon Legislature over a 12-year period, and during that period, Oregon produced a number of nationally recognized innovations in development policy. He received a bachelor's degree in economics from Lewis and Clark College and a master's degree in public policy from the University of California at Berkeley. And Dr. Tom Potiowsky will be our first speaker. Tom, please welcome.
Thank you. I want to thank you for inviting me once again to address the City Club. You have a rich history of civic responsibility to Portland and the state of Oregon, and it's a privilege to address you today. The Oregon economy has had a very rough road this decade. In terms of employment losses, Oregon shed 65,400 jobs from November 2000 through June 2003. Oregon's unemployment rate has been the highest or next to the highest among the 50 states for the last 41 months. And during this time, we learned that diversifying the economy away from natural resources did not make us immune from the business cycle. This particular recession was manufacturing-based, and Oregon has a predominance in manufacturing, in particular high-tech manufacturing. Oregon suffered more than most states in the recessions of the 70s and 80s, and this was also true of our most recent recession. Along with the private sector, state and local governments had historical drops in tax revenues. The last time state tax revenues fell proportionally more than in the 2001-03 biennium was during the 1933-35 biennium. Now, the recession is officially over. The official date for the end of the recession for the national economy, as announced by the National Bureau of Economic Research, was November of 2001. It would take almost 1.5 years later for the job market to get this news. Here in Oregon, we started adding jobs in a string of consecutive months starting in July of 2003. We had a good run until the summer of 2004, and the last 2 months of data that we have, October, November, we've seen some small declines in employment. Oregon has added 46,200 jobs since June of 2003. That leaves us 19,200 more jobs to go before we reach the pre-recession peak jobs set back in November of 2000. Now, just as the national economy hit a highly technically termed slowdown in the summer of 2004, which they called the soft patch, Oregon economy had its own slowdown as we closed out 2004, which I will likewise describe with similar technical jargon, hitting the pine tar. Now, will this recovery again get its momentum back and the jobs start coming back for us? Well, the most immediate worry that we have is really on the energy front. You know, as oil surpassed $50 a barrel and natural gas prices pushed upward and spilled over into higher electricity prices, both businesses and consumers found their budgets being squeezed. Add to this inventory buildups of components produced by high technology firms, and the pine tar can really get sticky. But the news has rapidly become better. Oil prices declining, semiconductor sales better than anticipated this past November, and the fundamentals for the U.S. economy I do believe the recovery is in place. And just as the U.S. economy appears to be moving through its soft patch, we believe the same will translate into a sustained recovery for the Oregon economy. Now, thus, our general outlook is for mild growth through 2005 and 2006. Let me give you some numbers. I'm an economist. I can't help myself. Job growth is forecasted at 2.1% for 2005 and 1.8% for 2006. Jobs will not reach their pre-recession levels of late 2000 until mid-2005, and that's an extremely long period of time before we reach those pre-recession levels. Note that this is very mild growth for recovery periods, especially if you look at the growth that we experienced here in Oregon in the 1990s. There is very little pent-up demand in the economy to cause any sort of big jump in growth. This also means that the Federal Reserve does not have to be overly concerned about inflation, and thus the recent rise in interest rates can be adjusted slowly upward as the economy improves, avoiding large jumps that can disrupt the economy. Hopefully, this mild recovery will work its way into a more sustained, mature growth path, and hopefully as long-lasting as the one we saw in the 1990s. Now, I'm going to just highlight a few sectors that my office is looking at of the ones that we do. Agriculture has benefited from the declining value of the dollar. Exports of agricultural products are up 23.5% year-to-date through the third quarter of 2004 compared to the similar period time in 2003. Now, whether this trend will continue will depend on both the value of the dollar, the strength of our trading partners' economies, modes of available transportation, trade negotiations, and the latest disease or hitchhiking insect that may be found on some crops. Now, after a banner year of 2004, wood products will only probably get an increase this year of about 0.6%. As interest rates rise, housing markets we expect to slow. Employment is also expected to soften in the wood products industry. The sector that contains semiconductors, computer and electronic products, will show the first increase in 3 years with a marginal rise of less than 0.1% for 2004. Jobs are expected to grow 1.3% in 2005 and 2.4% in 2006. And contrast this to over 10% growth 3 years running in the mid-1990s. Our forecast horizon goes out to 2011, and job levels, in our mind, still failed to reach the peak year of 2001. Transportation equipment will have a very good year this year at about an 8.4% growth in jobs. We think those job gains will slow down to about 2.5% in 2005 and relatively flat in 2006. Now, with only December's employment report still not tabulated, and that will be reported next week, Thursday, we expect private non-manufacturing jobs will have increased 2% in 2004, and they will increase 2.4% in 2005, 2.1% in 2006. Sectors that we believe will be relatively stronger, we believe all sectors will see some growth, but the ones that are relatively stronger are professional and business services and health services. We expect relatively weaker growth, but still positive, for the financial services sector. Also, as tax revenues have continued to improve, yet at a slow pace, government employment growth will likewise be positive, but at a slow pace too. Now, given this type of forecast, any forecast has risks, unknowns that can cause the outlook to either be stronger or weaker than what we're projecting. So here are just a few of the downside risks followed by the upside risks. And I'm just going to list these because many of these are self-evident as to their influence on the economy. Geopolitical risks, uncontrolled falling of the U.S. dollar, sharp and major stock market correction, rising regional energy prices, slower recovery for high-tech firms, and impending court decisions that could impact state and local government taxation and expenditures, in particular the PERS, the Public Employee Retirement Systems, current review by the Oregon Supreme Court, which we should hear about sometime maybe this month or in February. Now, there's also risk factors on the upside. Further declines in oil prices and milder increases in regional energy prices, recovering business and consumer confidence, and stabilization of Chinese and Indian economies. Now, regional energy prices are both a downside and an upside risk. The natural gas situation is not as dire as was first believed just a few months ago. And snow may finally be on its way to save our hydroelectric generation. So we marginally downgrade energy prices as a downside risk. So in summary, the recovery is in place. What you should expect is very mild growth across most sectors of the Oregon economy. Now, from that sort of short-term view, 2005, 2006, I also want to take a little bit of a longer-term view for our economy. And there's two risks, two among many risks that are out there, but two I'd like to highlight that face us, I think, into, say, 2008 to 2012 type period. First, although we always knew this, our state tax revenues are highly volatile to the business cycle. Oregonians collectively, not as legislators, not as governors, but as Oregonians, wanted less property taxes and tougher laws against crime. We asked for these things during the longest sustained expansion in Oregon history. As our need for expenditures rose, the tax revenues kept rolling in. The tax revenues were so strong that not only were we able to keep up with increasing expenditure demands, but we returned almost $1.4 billion in the last 10 years in personal and corporate kickers. Now, there's nothing inherently wrong with our tax structure, but we must recognize the highly volatile nature. It's very strong in the good times and it falls like a rock in the bad times. If we stay with this tax structure, we need a rainy day fund. We can be proactive on two fronts. Budget directly for the rainy day fund and divert any future kickers to this fund until it reaches acceptable levels to protect against future economic downturns. This action will also discipline spending. Now, my job at the state is to track and forecast the economy and general fund revenues. So my expertise does not really spill over to the expenditure side of the budget. But I do believe those who are experts in this area and worry about the level of social services, public safety, and the quality of our schools. An extension of the pain of the last few years by building a rainy day fund could avoid a larger disaster in the future. My office is presently forecasting a $43.3 million corporate kicker. Although not a large sum, it would make a great symbolic gesture and be the first installment to building a rainy day fund for us. The second long-term risk is offshore outsourcing. Although we heard a lot about it during the elections, the issue truly is not really that big today. The number of jobs offshored each year is about 2% of the total number of jobs displaced each year. But the issue has potential to grow in the future if we lose our innovation advantage that we have today. We tend to treat outsourcing, by the way, as an unfair trade practice. For example, if a Taiwanese chip producer would dump chips in the U.S. market at below cost to produce them, the U.S. firms would cry foul and request quotas or tariffs to be placed on the imported chips. We are basically making the same argument against outsourcing. We are saying to India and China, how dare you turn out engineers, chemists, accountants, doctors, and other white-collar professionals at higher rates and lower costs than we do. This is an unfair trade practice. You should stop supporting your higher education system. We don't support ours. So we sing the song of knowledge-based economy, but follow policies that prevent more of our population from access to college by raising tuitions and shrinking financial aid. If we want to compete, let's look at best practices overseas and assist our higher education system. In conclusion, and given the holiday season, I wanted to find some gala colors to sort of describe our economic outlook. So I considered the colors of the past year. As a country, we found ourselves under Code Orange security alert. As a country, we found ourselves, of course, after the presidential elections, we found that Oregon was a blue state. And in the Portland metro area, we are green with sustainability. From these colors, I thought maybe orange and green would work, or maybe change the orange color to yellow. Yellow and green to match the colors of the ducks. So, with yellow and green, we are in step with the ducks, and our outlook is cautiously optimistic. Thank you.
Well, Tom focused on the state of Oregon as a whole and on 2005 and in the short-term outlook. I'm going to be focusing primarily on the Portland metropolitan economy and really the long-term outlook for the Portland economy and what it will take to grow a successful economy here. But before I start, I know there's always a hunger in an audience like this to hear about the latest economic index. You know, what sort of indicators do we have about the direction the economy is going in? And one of the very well-established relationships that we economists have observed is that there's an almost perfect inverse relationship between the amount of attention that is paid to economists and the state of the economy. So that when times are good, nobody listens to economists. When times are bad, the room is packed. And based on this very strong relationship, we've developed what we call the City Club Economic Index, which we use to predict the coming year's economic activity. And the index is based on the attendance at this annual forecast meeting. And I'm pleased to report to you that last year you correctly forecasted the economy. The attendance at this meeting was down 40% from the prior year, which means people were very confident about the economy, didn't show up. So unfortunately, I have to report that attendance today is up 80% over last year, which means that you all are forecasting a weaker economy for Portland. However, it was pointed out to me that last year's meeting was held just at the end of the long snowstorms that we have, so we may have to make a seasonal adjustment to that index. What I'd really like to talk about today, though, is I'd like to talk about three things to give you an understanding of where we think the Portland economy is going, not only in the year ahead, but in the decade ahead. And to do that, first of all, I'll talk about the structure of the metropolitan economy, what makes it tick, and why this economy is different than other economies. Then second, I'll review our performance through the recession and through the more recent recovery and talk about the specific forces that have been driving, in particular, the metropolitan economy. And then third, I'll talk about the decisive factors that I think will shape the growth of the Portland economy in the years ahead. Brief introduction to thinking about a metropolitan economy. Now, if you do the tail of the tape on the Portland economy, you'll know that the metropolitan economy is the 6-county area, the Tri-Counties plus Clark County and Columbia and Yamhill counties. Within that 6 counties, there are more than 1 million people who get up and go to work every day. There are 2.2 million people who live here and are consumers and citizens here. And there are 65,000 businesses with a payroll. That's a big, complex system. It's difficult to make sense of that. And one of the tools that we as economists use for sort of separating out that complex system is to talk about the differences between what we call the traded sector of the economy and the local sector of the economy. Now, if you've driven around to other cities in the United States, you know that most of the businesses that you'll see in one city look pretty much like the businesses that you would see anywhere else. But pretty systematically, about 1/3 of the businesses in any metropolitan area or any place are going to be different from the kinds of typical businesses you find everywhere. And for the most part, those businesses are in what we call the export sector of the economy. They're businesses that sell their goods and services not in the local marketplace, but in competition nationally and internationally. And the important role they play in the local economy is that they bring in new revenue that's respent in the form of wages and purchases from other businesses. And the success or failure of businesses in the traded sector of the economy plays a decisive role in shaping the growth of the regional economy. And as it turns out, when you look closely at the traded sector businesses that compose the export sector of our economy, you'll see that it is not a random assortment of businesses. We are very good in certain things, and that tends to be true everywhere. And the kinds of things that we're good at are well known to us. We're the high technology industry that Tom Potiowsky talked about. We have significant concentrations of manufacturers of metals, machinery, and transportation equipment. We have a thriving creative services industry cluster, a major global concentration of sporting goods, apparel, and footwear manufacturers, the nursery products industry, food products, and a few others. And that industrial base is actually quite a bit different from the industrial base of the typical metropolitan area in the United States. As Tom noted, as a state, and this is also true of Portland, we are much more dependent on durable goods manufacturing to be the industrial strength of our region. And that is important because that really explains why we experienced this last economic cycle the way we did. And that's the topic I'd like to turn to now. Over the last 12 months, I'm pleased to report that in the Portland metropolitan area, we too have seen a rebound in employment. Employment is up about 1.3% over the last 12 months, a little bit of a slowdown in month-to-month growth in the last couple of months. That has been propelled significantly by the growth of our industry clusters. High technology employment in the region is up 6% over the last 12 months. Transportation equipment manufacturing is up 13%. Fabricated metals, another important industry cluster, up 11%. Machinery up 6%. So clearly we are seeing a turnaround in those key sectors of the economy. But we also know that the Portland area has been harder hit on average than the typical metropolitan area in the United States. Our unemployment rate is still over 7%, and it's going to be a while before we regain the peak level of employment that we experienced in early 2001. Now, some people blame Portland's and Oregon's relatively weak economic performance during this economic cycle on a bad business climate. They have what I call the Greek tragedy view of the economy, that if there's something wrong with our economy, it's because somewhere some economic gods are punishing us for some sin that we've committed. And I want to suggest to you that that's wrong. The economy is not a Greek tragedy. It is a complex, but unfortunately impersonal system. It doesn't make judgments about our policies. The important thing to note is when you look at the individual clusters that drive the Oregon economy and the Portland economy, we are actually doing better in Portland and in Oregon than those same industries are doing nationally. So over this economic cycle, for example, the high-tech industry nationally is down 25%. In Oregon, it's down by less than half that amount. The metals industry, likewise, is down 25% nationally and down only 17% in Oregon. The machinery industry down 21% nationally, down about 15% in Oregon. It is our dependence on those industries, not our relatively weak performance in individual industries, that defines why we've experienced this economic event more seriously than other places. The other thing I would note is, in many respects, we've been less well positioned to benefit from the things that have been growing in the U.S. economy in the last couple of years. As we all know, since 2001, the biggest growth element in the U.S. economy has been Homeland Security and the Department of Defense. Anybody who's familiar with Oregon knows that we do not have a lot of industries or military bases to benefit from that spending. So, for example, while military spending is up $750 million in the state of Washington over the last 2 years, it's up by less than $100 million in Oregon. So quite simply, our economic structure hasn't enabled us to participate to the degree that we might otherwise in the economic recovery. But one of the things I want to suggest to you as you think about an economic recovery is, in reality, there is no such thing as an economic recovery. If you believe that we are going to get back the same jobs that we lost over the last several years, you are mistaken. Most of those jobs are not coming back. The challenge of a recession outlined by Joseph Schumpeter, an economist, but writing about 60 years ago, was to deal with the reality of creative destruction. Because economies don't go backwards. I mean, our rhetoric of economics makes you think that it's a cycle that moves gently back and forth. But economies in reality only move forward. And we will not go back to the way the economy was in the past. The challenge of a recession, as Schumpeter outlined it, was to be creative, to create the next economy, not to recover the last economy. And that's what I'd like to talk about now. What are the essential elements that we need as a region to put into place to have a thriving economy in the years ahead? And increasingly, we will be competing in a global economy and an economy where our ability to be prosperous depends on our ability to create knowledge. Now, I've been participating in an effort that's proceeded over the last 3 years, the Oregon Business Plan. And in the Oregon Business Plan, a group of business and civic leaders have outlined a framework for thinking about Oregon's economic future. And I think it applies with great force to the Portland metropolitan area. And the framework we've outlined is what we call the 4P framework: pioneering innovation, people, place, and productivity. And we believe it's our combination of those 4 things, our ability to innovate new products, to develop and retain and attract talented people, to have a place that those people want to live in, and to be productive, is what's going to drive our economy in the future. And I want to suggest to you that in the Portland area, when we look at the indicators that underlie those 4 Ps, we'll see that we are very well positioned to grow in the years ahead. Now, it's hard to measure knowledge creation, but one of the best measures that we have at hand is patent activity. And even though the economy has gone down, employment has gone down over each of the last 3 years in the Portland metropolitan area, patent activity has actually increased by about 25%, from about 1,200 patents in the year 2000 to more than 1,600 patents in 2003. And patenting is increasing about 80% faster in Oregon than it is nationally. We're also creating new businesses. And you may think of recessions as these unalloyed declines in economic activity, but even in a recession, new businesses are being created. And businesses are being created in Oregon faster than they are in the rest of the country. In fact, in the last year, for which data are available, Oregon ranked 8th in the nation in new business formations. But most importantly, I want to suggest to you that the future depends on talent. As the motto of the City Club puts it so clearly, and I think it's enumerated directly here on the front of the lectern, is good citizens are the riches of a city. And it's the case that those citizens, as talented workers and entrepreneurs, are the future riches of our city. They are the basis for our future prosperity. I've been participating in a national study over the last couple of years looking at the migration of talented young people among metropolitan areas in the United States. Almost unnoticed, the population of young adults in the United States has declined by about 10% over the last decade or so. There are 4 million fewer 25 to 34-year-olds in the United States than there were a decade ago. As a result, most metropolitan areas are losing people in that crucial demographic group. But Portland is one of the big gainers. We rank 8th overall in the increase of 25 to 34-year-olds and 4th overall in the increase of college-educated 25 to 34-year-olds in the United States. And in fact, we are increasing the number of college-educated young adults 5 times faster than the typical metropolitan area in the United States. And overwhelmingly, they are being drawn to the center of the Portland metropolitan area. The number of 25 to 34-year-olds is increasing 3 times faster within 3 miles of where we sit right now, that is within the close-in neighborhoods of the city of Portland, than it is in the rest of the region. And the people who live in those close-in neighborhoods are about twice as likely to have a 4-year degree. So talented young people are being drawn to the center of our region. And all the evidence that we have suggests that that migration has continued even though our economy has been in decline or has been stagnant for the last several years. In fact, one of the reasons our unemployment rate is as high as it is because people continue to move here when the economically rational thing to do would be to move somewhere else. We did extensive interviews with young people who had moved to Portland and to other metropolitan areas that we studied. And we heard a number of reasons why people chose Portland, and some of them were the traditional reasons, the reasons that we've always known, that have to do with our natural environment and the incredible setting in which our city is located. But many of the reasons, in fact, most of the reasons, had to do with the character of this place and its community, the built environment and the way that we have cared for it, walkable neighborhoods, transit and bike-friendly streets, a tolerant and open culture, a place that engaged newcomers and allowed them to participate. And one focus group participant put it really clearly. Portland has a sense that it isn't done yet and that there's an opportunity for me to participate. And our ability to attract and engage those talented young people and to draw them here with our distinctive quality of place is an important economic asset going forward. And one of the things that I want to suggest to you is that when we think about the economic strategies that are going to be required to be successful, the one thing that we can rule out is that we do not have the option of trying to be a pale imitation of a strategy that we think somebody else used in the past in order to be successful. Our challenge is to build a strategy that builds on our unique assets and our unique advantages. Our challenge is to build the next economy. Now, I believe the building blocks are in place. We have pioneering innovation. We have talented people. We are attracting them here with a distinctive place. There is a great opportunity to build a vibrant, knowledge-based economy, and I hope in future City Club meetings we have the opportunity to talk about the dimensions of that change. Thank you.
I like the notion that Oregon isn't finished yet. I like that. In any case, we now come to the question and answer session of our meeting today, and there are microphones on either side of the room. Both of the speakers will be available to answer your questions, but questions are to be asked by City Club members only, and please try to keep them brief because we have a lot of people here and a lot of questions will be coming up. Marcus Samantel is our Board of Governors host today. He's retired farmer and has a master's degree in education from Portland State, has an extensive history of community involvement, including Washington County Planning Commission. He's been a City Club member since 1998, and he currently shares oversight of the issues committees. Marcus?
Thank you, Carlene. Did she mention I'm a retired farmer?
Did I say that?
And so I have to comment on what both Tom and Joe, they barely mentioned agriculture. And I would just share that agriculture continues in Oregon to be the #2 economic power, accounting for 8 to 10% of Oregon's economic activity. And I hope maybe during the question and answer period you might comment a little bit more on the importance of ag. But my question, I noticed that Tom's favorite word was hopefully. And I hope that his comments were correct about the future. Before we sat down or got going here, I talked with Tom and Joe a little bit about what can the legislature do to help out the economy. Can it truly have an effect? And I would like both of you to comment on that question now.
Yeah. Full disclosure here, and you may remember this from my introduction, I used to work for the Oregon legislature for a period of about 12 years. So that's a question I've reflected on a lot, and I'm not sure I can answer briefly. I would say that the decisions that we make as a state about the kind of place that this will be to live are incredibly important to the future of our economy. Short term, the biggest factor, and this came out clearly when we were talking to 25 to 34-year-olds, and this included unmarried and childless people, is the character of K-12 education. And I think historically the relative quality of K-12 education in Oregon has been an economic asset. I think it's a deal breaker for talented people. You have the option of sending your kids to another state for higher education. You really don't have the option of sending them to another state for good K-12 education. So unless we protect and in fact improve the quality of K-12 education, then I think that's the biggest single problem for the economy.
It's very difficult for the size of the state that Oregon is to have our legislative body, our governor, to make sweeping changes in our economy. It's much more directed by international, national conditions really affect our economy overall. But as what legislators can do in terms of policy is to provide an environment, as Joe is saying, both in terms, I think, livability here, an excitement that this is a growing place, this is the happening place where the new economy will hopefully spring forward, and it's a place of opportunity. And I almost, in some respects, think that that is going to be more helpful for us than particular tax incentive programs to have a business either stay or come here. Those tax incentive programs tend to be more what we might call icing on the cake rather than the cake itself. The items that Joe mentioned are more the cake. The tax deals may be more the break or make the deal type aspects.
Steve Novick, City Club member, and I think my question will give you a chance to elaborate on Marcus's. One thing you'll hear a lot in the legislature is that we'd have a great economy if our tax system were just more business friendly. But a couple months ago, the Tax Foundation released a report that said that we're already in the top 10 for business friendliness. Others will say we just need lower taxes to have a great economy, but every once in a while I look up other states and see that Minnesota, for instance, has higher taxes than us, and as of right now, at least a better economy. Would you agree that the impact of tax policy on a state's economy tends to be grossly exaggerated?
Depending on who you are, if you're the firm that's looking for that little extra tax break for you, then of course it's very important for that particular firm. I would have to somewhat agree with you overall that I think it is a little overplayed in terms of its role. In particular, if we take a look at why businesses want to locate here, and as you're saying, if we compare ourselves and compete against other states for these businesses, all the states collectively have reduced the burden of business taxes. And if we take a look at it as a percent of like for the U.S., even at the U.S. level, a very sharp drop has occurred since 1953 down to present day as to the percent of corporate income taxes paid relative to gross domestic product. And that's true for the state too. It's been a decreasingly lower percent that has occurred. But it's a running battle between states that I don't think has any winners. There are more important reasons out there why businesses locate in the state other than just what is your tax structure.
I agree with Tom. Taxes are grossly overrated as a factor in shaping. And I wouldn't just talk about businesses, talk about the health of economies. But clearly, by all objective measures, Oregon is a relatively low tax state. We rank in the bottom 10 in taxes as a percentage of personal income. And we also rank very favorably in business taxation. The final point I would make here is all those numbers, though, are based on these very gross aggregate averages of tax burden, and it really affects individual businesses. And some individual businesses find Oregon's tax climate much more advantageous than others. And politically, you'll always find individual businesses who would like to see the tax structures changed in one way or another.
David Roth, City Club member. Simple question of clarification from you, Joe. You were referring to growth in population in Portland relative to other metropolitan areas in the 25 to 34 category. Were you speaking as a percentage of population or as absolute numbers in that ranking?
Oh, the increase is in absolute numbers of people. That is, we have more 25 to 34-year-olds today, and most metropolitan areas have fewer.
Okay.
Hi, Joanne Kahn, City Club member. You spoke about numbers of jobs. I wondered if you'd comment a bit on wages and whether the jobs we're gaining are as good as the ones we're losing, and what's happening with the concentration of wealth and income disparity in our state versus the nation.
I'll take a shot at that. We've done there has been some work done by the State Employment Department to track the pay levels of individual jobs in the economy, and it's clear that a couple of things are true. First of all, that the jobs that we've recovered so far pay on average somewhat less, although this recovery, and I'm going to use that term a little bit loosely, is better than the last recovery that we went through. That is, this was far more serious in the early 1980s. And I think one of the things that we would expect to see is that that's probably going to improve over time. And in terms of wage and income disparities, I think there's some pretty clear evidence that the wage disparities tended to be moderating a little bit during the late 1990s, but I haven't seen any more recent data on that.
Yeah, I really don't have much to add to what Joe said. I would agree with that. The same study that I've looked at, too, from the State Employment Department has shown that, on average, probably the jobs that are coming back are a little lower on average than what we had before the recession. But we should be, as we were in the 90s, I think you're going to see some of that being pulled up again if this, I'll call it recovery, continues on into 05 and 06.
Doug Marker, City Club member, and I'm chairing the City Club study on stabilizing K-12 education funding in Portland. And Tom, my question is for you for a little more perspective on the statistics you cited about the state income tax during the 90s. During that period of growth, Oregon took on not only the prison funding, but also shifting the burden of education funding from the local property tax to the state income tax, and as well the Oregon Health Care Plan. In terms of stabilizing, right now the posture seems to be hoping that the good times come back. Can you comment on the role of the capital gains tax as a portion of the income tax revenue during the 90s and the likelihood that that might also return?
Yes, the capital gains for us is a very tough thing to track. We're modeling it now directly in forecasting for the general fund revenues. Our forecast is really good when we use the Wilshire 500 as an index to track where capital gains are going. And you can probably guess that forecast is only as good as your forecast of that stock market index, which, if I could do that, I wouldn't be here. I'd be in the Caribbean somewhere. So the capital gains really rose up quite dramatically in the 90s. And it was approaching about 11, almost 12% of the general fund revenues. In one fiscal year, it came crashing down by more than 50%. The following fiscal year went down another almost 30%. So you wiped out $400, $500 million worth of taxes in a very, very short order of time. Our outlook for that is we don't think that this historical, plus 20% growth of the market, never before seen in the history of the stock market since statistics were kept after the Civil War, is going to return anytime soon. So that kind of run-up we don't expect. We expect it to recover somewhat, but our forecast goes out quite a distance before we even start to even get close to our previous amount. So as a source of growth, our forecasts do not have it in it right now.
Bill Parrish, City Club member. On Wednesday, the Willamette Week did a story related to Portland General Electric in which it was estimated that Texas Pacific Group planned to pull about $1 billion out of PGE in terms of profit. My question is this, Tom and Joe, if you look to your right, both of you, and rather than see our illustrious City Club president, you saw Governor Kulongoski, and we're up to you to advise him on whether or not Texas Pacific should be able to purchase PGE, what would you say?
Marcus will take that.
Yeah, as an economist, I have an occupational handicap, which is I try not to answer questions when I haven't looked at the numbers, and that's one where I just haven't looked at the numbers, so I wouldn't offer any advice.
Okay.
Joella Whirlin, club member. I would like both of you to talk a little bit more about the agricultural sector, because I have the feeling that there are two very two very different moods in the state of Oregon, and certainly the discouragement that the more agriculturally centered parts of the state are feeling are affecting school funding and other actions in the legislature. Could you talk about the state of the agricultural economy here?
Sure, I'll take the first shot at that anyhow. Marcus is far too modest when talking about agriculture. The single largest segment of agriculture in Oregon, anybody know? The nursery products industry accounts for more than 20% of all ag sales, more than $700 million, I think is the latest number that I saw. So it's not necessarily the traditional agriculture. More deeply, I think there's a fundamental set of changes afoot in agriculture, and it's a shift from the traditional commodity-based industry that we have had to much more of a specialty product industry. And all of the things, commodity is just basically you grow as much product X, wheat, as you can, and you send it to the market through whatever mechanism you can. The growth in Oregon agriculture has really been in the nursery products, which is much more attuned to consumer marketing. It is not a commodity product. It's very differentiated. Each individual producer grows their own varieties and markets them. But it's also the growth of specialty food. It's the growth of the organic and the natural foods and so on. And we're seeing phenomenal growth rates there. And I think one of the things that we're likely to see over the next decade in the United States is just a fundamental change in the way food gets to our tables. And there's a huge opportunity for entrepreneurship there, not only by farmers, but then also in the distribution system. And we have some really excellent innovators in the Chefs Collaborative, in the farmers markets that we have, in things like New Seasons and the other markets here. So expect the food business to change pretty dramatically, and that could ripple through and benefit, I think, the Oregon economy in a lot of ways.
Yeah, I'd have to agree with Joe. Yeah, I mentioned about exports, and what I didn't say is that the value of exports is held by agriculture is the second highest in the state. The highest is computer electronic products. And the agricultural products have been, in terms of jobs, relationships to those, I've seen various studies that have said maybe possibly 1 out of every 12 jobs is somehow agriculturally related that occur in Oregon. So it is a very important industry for us. And actually, it's actually turning to be somewhat of a high-tech industry. And what I mean by that is you have anywhere from processing plants that are state-of-the-art to out into the field where they have monitors so that they know the most efficient time to water, the most efficient time to use any particular type of pesticide, so that they can be more cost-effective in doing that kind of business. So, yeah, just to reiterate, it is a very important business for us.
Elaine Kogan, we probably shouldn't conclude any of these discussions without the question that always comes up about, do we need a third leg to the so-called three-legged stool of our tax policy? And I'll let you define what that might be.
Well, let me guess. A head tax, right? And that's, well, you know, the idea of a sales tax always comes around. You want to keep in mind with a tax structure, it has to comply with certain needs and certain criteria that you want a tax structure to have. You know, first, you have to have a tax structure that brings in enough taxes to meet the needs of the public's desire for public services. It has to at least be that level. And then you have issues of fairness or equity. Some economists will argue, actually most economists would argue, that probably a progressive income tax that has progressively higher marginal rates is more fair than a sales tax which has one rate, because generally people at higher incomes in a sense pay a smaller percentage of their income in sales tax than what low-income people do that don't save anything and spend all their money. It's almost as if they had an income tax is the same thing as a sales tax to them. I've also heard arguments that, no, that's not true. People with higher incomes spend more money, so they pay more sales taxes than low-income people, so they're actually a higher burden on the higher-income people. So depending on your particular quirk and view of this, you can get all sorts of different ramifications. The other part that you want to look at is stability. And definitely a sales tax is a more stable source of tax revenue than an income tax. You know, and keep in mind, an income tax, it really is going up and down with the business cycle. What people tend to do is they tend to save in the good years, dissave in the bad years. They would prefer to smooth their spending out over time. It still has a cycle, but it's not as large as what income does. So that would be one of the positive reasons to have it. Then you have it on more localized aspects. What about all the visitors that we have that come into the state? They add to our, of course, state taxes indirectly because they may buy goods and services, and businesses then get taxed, and in that way they are paying for part of our taxes. But there's a lot of directness that would be had if they were also paying a sales tax to come into the city. And if we take a look to the south at San Francisco, it doesn't appear that having a high city, or in their case, a high sales tax, really keeps visitors away if you have a reason to come to visit and be a tourist to an area. So with all that in mind, I feel that our present tax system, and I said this today, I don't think there's anything inherently wrong with it. But if you want to live on a roller coaster, you've got to be able to be prepared to do so. And this is why I'm calling for a rainy day fund, a true one that we have. Because if we stay with this system, it's going to roll in better in the good times. It really dries up in the bad times. The only true way to get through that is to have that rainy day fund to help you through the really tough times. So, in my mind, we could go with a sales tax. That would be fine, but inherently I don't see anything wrong with our present system.
I don't think there's anything wrong with the current system that a stabilization mechanism like a rainy day fund wouldn't fix. There's no inherent advantage to a sales tax. There's one point Tom left out, which is every state that has a sales tax base is seeing that tax base get narrower and narrower as a result of a couple of things. First of all, people are spending less on goods, more on services, and then you have things like internet shopping and so on. So the sales tax may look somewhat attractive, but in fact it's a narrower and narrower base, and it's not, it doesn't have anything to recommend it. And I would argue that actually an income tax is a long-term a better tax to have. But given the structure of our economy, the structure of our tax system, we really need a very good rainy day fund.
Hi, I'm Lucy Baker, a new City Club member. In this 5-year period, the first of the boomers are starting to retire, and it's going to get a lot worse with the loss of some of the highest skill levels and experience in the state. What do the economists have to say about that?
Thanks for that question, because that's a point I wanted to make. One of the reasons why the ability to attract talented young workers is so important is we're going to see the baby boomers moving out of the workforce in large numbers over the next decade. That's going to create something of a brain drain. We're seeing it already in some sectors of the economy. I know it's hard after 3 years of declining employment and high unemployment rates to talk about a labor market shortage, but not only do we have the baby boomers moving out of the workforce, all of the things that have caused the growth of the U.S. labor force over the last 3 decades essentially turn around in the next 10 to 20 years. The first is the boomers. The second is women's labor force participation. Over the last 3 or 4 decades, women have essentially doubled their amount of work in the paid workforce. That isn't going to happen again because women now work just as hard as men in terms of their involvement in the paid economy. The third point is that we are not expanding the number of college graduates nearly as rapidly, in fact not at all anymore, above what we had been doing historically. And there's been a huge growth over the last 3 decades in the number of college graduates because essentially we've tripled the number of adults who get a 4-year degree in the United States. And there isn't going to be any increase in the years ahead. So in the next decade or so, labor markets are going to be tight, and places that have talented people will be the ones who do well economically.
And also, you want to keep in mind that if there is a shortage, the one way you can fill that up is the baby boomers will not be retiring in the big numbers. They will continue to working, and I expect to one day probably be greeting you at Walmart.
I'm sorry. And on that uplifting note, we are adjourned.